I'm Jeff Spolstra with Summit Mortgage, and this is Mortgage Points. In this video, I would like to talk about loan affordability. Affordability, what does that mean? What does it mean that a loan is affordable? Well, there's two components to that. One is a technical component, meaning that there's a measurable element that I, as a mortgage lender, need to stick to in order to determine whether a loan is affordable for a particular buyer. And there's also a personal component. Just because I tell you that a particular loan is affordable or a particular monthly payment is affordable doesn't mean that you are comfortable paying that amount. So let's cover the technical area first. Technical, the number one measure of loan affordability is your DTI ratio. DTI, debt to income ratio. Now, so you might hear that and you say, well, that must be a measure of how much debt I have compared to my income. And that's not quite what it is. It's more a measure, it is a measure of, I should say, how much it is costing you per month to keep the debt that you have versus your gross qualifying monthly income. So it's more about your monthly payments than about how much debt you have. You might be $10 million in debt, but if you're paying $200 a month on that debt, I only care about the $200. Conversely, you might be $100,000 in debt and you're paying $2,000 a month on it. Well, I definitely care about the $2,000 a month. So we're going to look at what is it that it's costing you on a monthly basis to service the debt that you have, your credit cards, car loans, student loans, whatever shows up on your credit report as a credit obligation that you have to make monthly payments on. That's what I care about. And I'm going to add to that what I anticipate to be your monthly housing obligations for the home you want to purchase. What are those? Well, that's your principal and interest on your mortgage for sure. It is your property taxes calculated on a monthly basis. It is your home insurance costs on a monthly basis. And if you're buying like a condo or a townhouse where there's an HOA, it's going to be your HOA fees on a monthly basis. Those five things, PITIA, association, are going to be added to all of your other monthly debt obligations, and that's going to be the D part of the ratio, the debt part. And I'm going to divide that monthly obligation by your gross, not your net, your gross qualifying income. Remember, we talked about gross qualifying income in a previous video. It's the income that we can use to qualify you for a mortgage, and this is why we need it. It's the income that's going to go into this ratio. So your current debt obligation plus your anticipated housing obligation divided by your gross monthly qualifying income is your DTI ratio. Now, what's the limits on that? Well, it kind of depends on the loan and the particular loan program, but you can generally assume that the maximum is 50%. No more than half of your gross qualifying monthly income can go towards paying your current debt plus your anticipated housing obligation. So if you're making $12,000 a month gross qualifying income, $6,000 of it is all I can apply towards your current debt and your anticipated housing expenses. And that's a good thing, right? Because we're dealing with gross income. So by the time taxes and all that stuff comes out, you're probably actually looking at more like a 70 to 75% ratio for your net income. So 50% is a pretty good limit. Some loans are less. Some programs are less. 45% is not an uncommon limit. There can be 40. There can be even as low as 37 or 35%. It just depends on the risk factor of the loan. So from a technical perspective, that's what determines affordability, right? Your DTI is really the number one most important income to qualify for a mortgage. Everything else rolls up to that: income, credit score, et cetera, et cetera. It's all going to eventually roll up to affecting your DTI. And if your DTI is out of bounds, you're not going to get that loan. Either you need to get a smaller loan, or you need to somehow get more income or lower your other debt obligations. DTI, number one thing for determining whether you get a loan or how big a loan you get as an affordability measure. Now, that's technical. What about what you think? What you personally feel about how much money you're going to spend per month? And that's the personal part. That's up to you. I work with clients who I can tell them that what their affordability is technically, and they want to purchase way less than that because they know what might be coming up. Maybe they're looking at kids who are going to be going into daycare soon, and they need to allocate part of their income for that, or schools, or whatever else may be coming. So just because you technically can afford a particular loan amount doesn't mean that you personally want to pay that amount on a monthly basis. So has a technical and personal components to it. I can tell you the technical, you've got to decide for yourself what is affordable for you, what you're comfortable with. So loan affordability, very important, been important since the crash of 2000, because it's critical that I don't want to give you a loan that you can't afford, either from a technical perspective or from your own personal perspective. Okay, loan affordability. My name is Jeff with Summit Mortgage, and this has been Mortgage Points.